Hello everyone. Today I would like to talk about the important problems in mutual fund industry in India. A mutual fund is primarily a mechanism which pools resources by offering units to investors for investment across several classes of assets. There are several types of mutual funds offered in India such as equity, debt, balanced tax savings, and fixed maturity plans among others. Whether you are a seasonal or first-time investor, a mutual fund is something you should seriously consider adding to your investment portfolio. However, you should be aware of the advantages as well as possible pitfalls of this investment. We know that the mutual funds in India have not been able to perform up to the desired level and in many cases have expressed their financial inability to repay the invested capital along with promised rate of returns. So, before you invest in mutual funds, you should do your homework. Let us take a good look at several so-called disadvantages of mutual funds. They are liquidity crisis, lack of innovation, inadequate research, conventional pattern of investment, no provision for performance guarantee, inadequate disclosure, delay in service, no rural sector management, poor fund evaluation, over diversification, fluctuating returns, and no control over cost. Let us study all these one by one. The first one is liquidity crisis. Mutual funds in India face liquidity problems. Investors are not able to draw back from some of the schemes. There is no easy existing route. Indeed, bad delivery have caused a lot of problems and liquidity crisis for the mutual funds. Another problem faced by our mutual fund industry is lack of innovation. That means mutual funds in India have not been able to provide innovative schemes in terms of risk, liquidity and choice of the investors. Next one is inadequate research. Most of the mutual funds in India are suffering because of inadequate research facilities. That means most of the funds depends upon external research and have no facility for in-house research. So they should provide more money on the research and development if they want to be successful in future. Next one is conventional pattern of investment. Mutual funds in India have been following conventional pattern of investment. So they have not been able to diversify the risk to a large extent and which has caused low return on investment. Another important pitfall of mutual fund industry in India is they have no provision for performance guarantee. It means mutual funds in India have so far failed to provide performance guarantee to the investors. Inadequate disclosure is another limitation of mutual funds in India. Obviously, there have not been adequate and timely disclosures of mutual fund material information to the investors by the mutual funds in India. Next one is delay in service. It means mutual funds in India have also not been able to provide quick and adequate services to the investors. Moreover, in many cases, there is no response to the investors' grievances. Another limitation is they have no rural sector management. Indian mutual funds so far have not been able to create rural sector investment base. The exact reason for this problem is that they have not made any sufficient effort to educate the potential investors. So, mutual funds should launch investors education programs and expand their activities to rural areas. Next one is poor fund evaluation. That means many investors may find it difficult to extensively conduct research and evaluate the value of different funds. A mutual fund's net asset value provides investors the value of the fund's portfolio. However, investors have to study various parameters such as Sharpe ratio, standard deviation, among others, to ascertain how one fund has fared compared to another, which can be complicated to some extent. Another problem is over-diversification. Diversification is often cited as one of the main advantages of a mutual fund. However, there is always the risk of over-diversification, which may increase the operating cost of a fund, demands greater due diligence, and dilutes the relative advantage of diversification. Next one is fluctuating returns. Mutual funds entail a wide range of price fluctuations. In other words, we can say mutual funds do not offer fixed guaranteed returns. In that, you should always be prepared for any, eventually including depreciation in the value of your mutual fund. The last but not least important problem of mutual fund is that they have no control over cost. We know that in mutual fund, all the investors' money is pooled together in a scheme. Here, costs incurred for managing the schemes are shared by all the unit holders in proportionate to their holdings of unit in the scheme. Therefore, an individual investor has no control over the cost in a scheme. And other important thing is that SEBI has, however, imposed certain limits on the expenses that can be charged to any scheme. These limits vary with the size of the assets, and the nature of the scheme is published by the mutual fund company. Okay, thank you for watching my video.